If we pick up the fundamental side, there was a major earnings slowdown. Government spending slowed down. There was probably unintentional level of monetary tightening that happened. There was a huge liquidity deficit. There was very intentional regulatory tightening that happened. So all that meant that economy slowed materially. So to give you a sense, FY25, we started with earnings estimate that FY25 earnings will again grow 18%. But now that expectation is down to some 6-7%. I think FY26 expectations were about 17-18% growth. It's now been tempered to about 14% growth. My actual belief is that over the next couple of years, we will have very choppy markets. I think we are past the trending market phase.
The Indian markets have seen a dramatic shift over the last year. About a year back, the Indian market seemed invincible on a one-way track. But however, over the last couple of months, we've seen fairly volatile times. The market has corrected quite sharply. Mid caps and small caps in particular have seen significant corrections. And as we stand, we live in very choppy times given what's happening in the global macro environment. So what has happened? What resulted in this big shift? And what bodes for the future of Indian equity markets? This is the topic for discussion today. And joining me today is Ashish Gupta. Ashish is the Chief Investment Officer at Axis Mutual Fund. Ashish, welcome to the show.
Thanks, Amir.
Ashish, as we start, I want to reference two conversations you and I had, one a year back and one I think about 6 months back. The first one was on the F&O market in the country. And you had published a piece of research then showing how extreme it was and what all kind of type of activities were happening. Subsequently, a lot of conversation has happened, a lot of action has also happened. And the second conversation I want to reference is the discussion we had on the supply side of equity.
Yes.
Again, I think this was September of last year, I think, when we did this, where at that time, by the way, the Indian market looked like it was just rocking, right?
Sure.
And then again, you had written a piece saying that, look, the market is a market, while there is a lot of domestic inflow coming.
Sure.
But like any other market, any other efficient market, our markets will also ensure that the supply meets demand and, somewhere an equilibrium will come. And looks like that has kind of played through. So let's just start from this. Maybe we start with the options side first, and will be helpful to understand how has that world changed now.
So that world has seen significant amount of scrutiny by the regulators in the past 6-9 months. The regulator put out first set of measures to tame some of the animal spirits that were abounding, and these have been implemented from December to February. And the good news is that we have seen some tempering of the enthusiasm there, particularly the volumes on the expiry day options, they have significantly moderated.
Right.
But the overall option volume still continues to be very, very large. And large, not just in absolute sense, but in relation to the cash market. And my belief always has been that option market is a derivative market, right? The market does not exist for its own self, right? It has to have a connect with what are the options on. It has to have a connect with the underlying, which is the cash market. And if we look at even after these sets of measures, let's say the notional value of the option market to the notional value of the cash market, that is still a very high number. That's almost 300 times. Even if you look at options premium to the cash turnover, that at 0.5x is really high by all global standards. So I think that is something that still need tempering. Of course, since October, November, total option volumes have moderated, but that has also been, as you mentioned earlier, a period where there has been a market correction. So both the market price has come down as well as cash market volumes has come down. Therefore, the size of the option market relative to the size of the cash market has not moderated as much. The good news is that now regulators are very cognizant of it. They are trying to really block all sources of risk in the market. They have just about 2 weeks ago come out with a further set of discussion paper that needs to really foster more orderly functioning of the options market. So I think uh, it's a market that is still too large in my view. But the good news is that regulators are actively looking at it, monitoring it, and hopefully the steps they will take will ensure that there is no kind of accidents that happen in that market and it does not have any cascading impact on the cash market.
So summarize, basically, the situation has tempered, volumes have come down.
Yes.
It is still large,
Yes.
but the direction seems to be towards kind of further tempering.
Yes.
And so hopefully over a period of time, we will see that it reaches some more meaningful proportions. Great. So moving on to the equity market.
Yes.
Last time we spoke, everything was hunky-dory, everything was in the green.
Yes.
We had foreign companies IPOing in India.
Yes.
And so on and so forth.
Yes.
And how the world has changed.
Yeah.
So what are 2-3 things that happened, Ashish, in
Sure.
this time frame?
So I think if we look at the things that change, I'll probably put them in two buckets, right? So one is the technical side and the second is the fundamental side.
Right.
If we pick up the fundamental side, there was a major earnings slowdown that started to come through.
Right.
If we see in the period post-COVID, there has been a strong earnings recovery in corporate India. Corporate earnings recovered much faster than GDP. At its low, corporate earnings to GDP, it was 1.9%, right? And it's moved up to nearly 5% of GDP, right? And of course, post-COVID, your GDP recovery was also strong. So both combined meant that you had a very strong 23-24% earnings CAGR. And in some pockets, the earnings CAGR was even sharper. In addition to strong earnings growth, if you look at 2023, for example, there were earnings surprises. So actually markets moves as much on earnings growth as it moves on earnings surprises. So every quarter after the quarterly earnings came in, earnings were getting upgraded, right? And that started to change in 2024. And actually, even before the market started correcting, if you, for example, go back and see March 24 and June 24, you stopped seeing earnings upgrade coming through and you saw minor downgrades come through. So March quarter earnings, March 24 quarter earnings were neither upgraded nor downgraded materially. June 24, they had a mild downgrade, but from September 24, you saw significant cut in earnings because companies started missing earnings, right? And there are multiple reasons for it. One, the GDP growth itself kind of started faltering. And you would recall in the September quarter, GDP growth went down to less than 6%. And we were literally for the previous 2 years running close to 8% GDP growth. There are multiple reasons for it. Government spending slowed down with election, and even post-election, it did not come back as quickly. There was probably unintentional level of monetary tightening that happened. And that was also exaggerated by the fact that we saw significant amount of foreign capital outflow. And as the central bank intervened, it took out liquidity from the market, and there was a huge liquidity deficit. There was very intentional regulatory tightening that happened. right? So all that meant that economy slowed materially, and that of course started reflecting in corporate earnings. I think in addition to that, we saw margins for many companies peaking out, new competition emerging, and we have seen earning disappointment coming through. And if you see September quarter, December quarter, we saw significant amount of earnings downgrade. So you actually saw about 6-7% earnings downgrade. So the kind of expectations that had got built that you will have 20% plus earnings growth continuing started faltering, right? So to give you a sense, FY25, we started with earnings estimate that FY25 earnings will again go 18%, right? But now that expectation is down to some 6-7%, right? And I think FY26 expectations were about 17-18% growth. It's now been tempered to about 14% growth. But again, the jury is out, and as the March quarter and the June quarter earnings come in, you'll get to see where do FY26 earnings go. So I think those are really the fundamental shift that happened that led to tempering of enthusiasm and the
Right.
The second thing, which is more technical, is on the liquidity flows, right? And that's what we spoke about, that we were all focused on the fact that domestic liquidity was so strong that multiples kept on moving up, right? But we saw from September, so really the market peaked on 26th of September, was that as US yields went up, foreign flows turned negative. So if you see the first half of last year, foreign flows were positive. And despite the fact that the supply side, all the IPOs and private equity stake sales were much larger than the domestic inflows, the market still continued to go up because foreign flows were also positive. From September, foreign flows turned negative, right? And that was, you can ascribe various reasons to it. One reason could be that you had drop in earnings estimates in India, but I think the more important reason for it was what was happening to the dollar index. So dollar index went up from whatever 103 to 110. You had US yields going up by 100 basis points from 3.75% to 4.75%. And when you had this foreign outflow, the supply side overwhelmed the domestic inflows. So the good news is that the domestic inflows have continued to be reasonably strong, but in the absence of foreign inflows, they were not substantive enough. And that's what's led to the multiple correction, right? Because the multiples had expanded because there was a flood of liquidity. So yes, earnings growth in India was strong, but the returns that have come through over the last 4 years have come both from earnings growth as well as multiple expansion. And actually, if you look at various cohorts of companies, there are companies where 70 to 80% of price appreciation has come from multiple expansion rather than earnings growth. So I think that's really what's materially changed. And I think you saw a very steep correction. So actually the index does not tell the full story, right? So the index from its peak corrected till end of February by about 15%. But if you actually look at the median correction, that was around 30%.
Right. Understood. So Ashish, just to again summarize this, basically if you look at very conceptually, simplistically, any stock price and also the index, there are two components to it. There is one is the multiple, and second is the earnings and earnings growth.
Yes.
So your expectation of the level of growth of the profits.
Yes.
And second is the multiple you are willing to pay on that growth of profit.
Yeah.
Post-COVID, what happened was actually during COVID, both the multiple as well as the earning growths dipped quite dramatically because of COVID. And post-COVID, the earnings growth started to surprise.
Yes.
Because, analysts and folks like you were expecting, let's say, 15%, but actually Nifty delivered, let's say, 17%.
Yeah.
So you basically said that, oh, okay, maybe we should kind of up our expectations. At the same time, the multiples also expanded because of the kind of new domestic flows and, foreign flows also coming in and so on and so forth. So we had a situation where both the price to earning, which is the multiple, as well as the profit growth expectations were both at an elevated level. And then because of whatever has happened, the expectation on both has fallen. And so there is a double whammy actually. And maybe when we spoke last time, let's say in September, we were at the peak on both. We were kind of expecting great profit growth and great multiples to continue. Which means that actually, the margin of error is very, very limited. Like anything can go wrong and can kind of
and actually the challenge in the market is that both these aspects are correlated.
They're cool, exactly.
Right. So while we talk of them as different things, the fact is that maybe the flows also moderated because the earnings growth moderated, right? So so that's really as you said, the double whammy, it plays out both ways.
Right. And actually, you'll know better, but my guess is if you took let's say a 50-year view of the markets, you would typically find that the two are always correlated. When the earnings growth starts to surprise on the upside, the multiples start to expand. And when the earnings growth surprise on the downside, the multiples derate. And so I guess this is always
and that is why I think whether you talk about a fundamental target price setting or even technical analysis, this is why these work, right? Because these are patterns that are repeated again and again, right? And that's why people say, what is the average P of the stock? So you kind of want some benchmarking to what is the long-term sustainable level, right? You will have swings both ways, but you have to be cognizant that, okay, if valuations have gone, multiples are 2 standard deviations away, you don't know the reason, but whether the profit will slip or some technicals will change or yields will go up, you can actually predict that, okay, if the market is 2 standard deviation away on multiple, then historically 95% of the time it has traded lower. So the probability something is going to change is higher now.
Right. Understood. So that is one. The second thing you said is the kind of the liquidity side of this, which is again, when we spoke, there was this very strong belief that, domestic liquidity flows are strong and they'll continue to be strong because of structural shifts. And that domestic flow will, ensure that the multiples continue to, keep getting elevated. And that's something actually you predicted then, saying that, look, this is not likely to happen because it's the market. At some point in time, if the multiples are really, really high, a new supply will come in. Promoters will say, let me kind of sell versus kind of holding, and which is what actually also happened. And then various reasons have kind of also come in and derated that multiple. Great. Very helpful, Ashish. So now taking this as the basis, there are two angles I think will be helpful to go to.
Sure.
First is just some, beliefs or myths, let's call them. And second also, as we are recording this interview yesterday night, Donald Trump has announced the tariffs. So will be helpful to cover that also.
Sure.
So first on the myths, for a long time, and a lot of the investors in India are only 3-4 years old in their investing journey. Including, by the way, there was some press article which said that even mutual fund managers are, perhaps kind of have seen only unidirectional kind of this thing. Having said that, the markets, are kind of where there is risk, where there is return, there is always risk as well. So the markets don't always work like this. Will be helpful, Ashish. You have a long view of this, so will be helpful to understand this from your perspective with some historical data.
So I think markets always have risk, and in fact, in our mutual fund I totally agree with you that we have to have people who have seen cycles, right? So whether we are hiring analysts, we are onboarding fund managers, we want people who have seen cycle, right? So the average experience, for example, for my analyst and fund manager team is 15 years. So
Right.
like one of the basic kind of filters we have for a research analyst is someone who has seen at least one cycle in his sector, right? Because otherwise, if someone has only seen last 3-4 years one-way street on a company or the sector, he cannot potentially gauge all the risks that come by way. I think in terms of how to really control this, one, of course, is diversification. You have to manage diversification both ways. You can't be too concentrated and you cannot be over diversified because even statistically it's been proven over diversification actually reduces your return, dilutes your return without really reducing risk.
Right.
When markets are volatile, when markets are choppy, actually you have to have actually confidence in the underlying companies and the managements you own, right? Because the market mood and sentiment changes at the flip of a coin, right? And if you just kind of roll back over the last 6 months, as you said, September, everyone thought nothing could go wrong. January, February, everyone said everything is going to zero. In the month of March, the market has had a 6-7% return again, right? So the market sentiment changes very quickly. And so it's very important to really have high degree of confidence, right? Now, let's say if you are building a portfolio, and I'm talking as a personal investor, right? If a person is building a portfolio, you'll have strong conviction on 1 to 10 ideas, right? By the time you go to a 30th idea or 40th idea, and again, that number may change with the person who's doing it, the conviction he has is clearly lower, right? Because whatever he had higher conviction, he has already bought, right? So the more you go into the tail of your portfolio, the conviction level is actually lower. And what happens then is that if the momentum of price is right, you will hold it. As soon as the momentum changes, you are actually unsure of it and you'll bail out of it, right? And that may not be the best point of doing it, right? So I think it's really important to have conviction in what you hold, because my actual belief is that over the next couple of years, we will have very choppy markets, right? I think we are past the trending market phase. In the last 4 years, we saw very top-down narratives play out that we will play this theme, etc. I think that phase is over for us. I think we will see very a choppy markets given that the degree of uncertainty has materially gone up, right? Because last 4 years, whether you look at global economy, Indian economy, it was a one-way street, right? And that's not going to continue. And we'll probably talk about a bit more when we come to all the Trump announcements and the aspects of it. So I think over diversification is the second is that you have to play multiple asset classes, right? I think for investors in the past few years, because of return, because of taxation, I think people have gravitated toward just one asset class, which is equity. I think you have to have a more balanced portfolio. It has to have equity. It has to have fixed income. It has, and we spoke about gold in one of the earlier episodes. So you have to have. So actually, if you see last year, fixed income funds outperformed the equity funds.
Right.
And although on a full year basis, equity funds still had positive years, the index was up about 5% odd. Most of the actively managed funds actually outperformed the index. So the returns were not insignificant, but actually fixed income outperformed equity. But as an investor, you have to have a balanced portfolio across asset classes. You cannot just gravitate towards one asset class. The other piece is, I think, you have to be invested in the market. You have to refrain from trying to time the market, right? Because it's impossible to do on a consistent basis. And actually, there has been a study that it was actually on global markets that if you kind of miss out on some of the big trading
most
yes,
yeah.
right, you actually lose nearly 40% of the return, right? So it's really impossible to kind of time those. Lots of time those big moves happen even without a fundamental announcement. It's just that the market is oversold. There's a big short covering. So you have to stay invested for the longer period of time. I think my personal belief is it's really not about large cap, mid cap, small cap, etc. I think risk is best controlled by being invested in a longer time frame. And there is statistical evidence for this as well, that both your expected return and the standard deviation of return improves the longer you are in the market. So if you are invested in the market for 3 years versus 5 years, and you do on a rolling return basis, I think on a 5-year or a 7-year basis in India, there is no period of actually negative return, right? So the probability that you will have a higher expected return is more if your time frame is longer. So I think it's really important to stay invested for the longer duration. It increases both your return as well as reduces the risk.
Right. So Ashish, again, kind of, I'm paraphrasing a little bit. First is that equity markets operate in cycles.
Yes.
And we have, in India, we've seen many cycles. If you go to the US, they've seen many more cycles because obviously they have a longer history. So as an example, 2003 to 2007 was, again, it was a, golden era, right? Like it was a one-way street, everything went up and so on and so forth. And then the global financial crisis happened. And again, at 2007, both the price earnings and the expectation of profit growth were at a peak. They both, crashed. I think both Sensex Nifty lost 60%, if I remember right.
Yes.
So that happened. If you think of the time frame between 2013 to, let's say, 19,
Yes.
markets broadly did nothing.
Yes.
Right. Obviously, they went up and down, but broadly they did.
Yes.
Kind of the returns were not great. And then post-COVID, we saw another wave. And now we are seeing a little bit of a correction.
Yes.
Now obviously, you expect choppy markets. Nobody knows what the future holds.
Yes.
But we will see this kind of behavior continue just because both the multiple and the expectations are correlated, and they kind of amplify each other's impact.
Yes.
So it's in cycles.
Yes.
Unlike, let's say, fixed income, which is like if you put your money in FD, you will get your 7.5%.
Yes.
Irrespective of what happens to liquidity, what happens to Trump, and so on and so forth. So these operate in a different way. And hence, from what you said, like as a retail investor, I would say we have to compartmentalize these, right? Like if we put all our eggs onto, let's say you want something, you have a very important event coming up 1 year down the line.
Yes.
And you put all your money into equity, that might not be a great this thing. At the same time, you are, thinking about your retirement or your, child's education, which is 15 years out or 10 years out.
Yes.
Then keeping money in FD may not be a great idea. So you have to kind of think of this portfolio and the diversification point that you made. So that's also another relevant one. This notion that equity markets always go up is not right. But equity markets do mostly go up over a long period of time, and they will outperform almost all other asset classes over long
So
period?
I think you mentioned the two time frame 2003 to 2007 when equity markets gave great return, in 2013 to 18 they did not, right? So besides all the technical factors, I think one important underlying factor is what is the economic growth,
Right.
And why we still kind of over the long term are still positive is that we still have confidence that okay, Indian economy will do well. It may not grow at 7.5%, it will grow at 6.5%, but at the end of the day, equity markets are going to reflect what's happening on the economic growth, because economic growth will reflect in corporate earnings, and that's really your main underpinning for your returns. You should not really bet on re-ratings to drive your return, because over long periods of time, only earnings growth will deliver you return.
Correct.
Right? And if I put some framework around it, let's say your real GDP growth in India is 6-7%, right? You have inflation of around 4-5%, hopefully. So you get 10-11% nominal GDP growth. Corporate earnings typically grow a couple of percentage higher than that. So that's really should be your return expectation if you invest for a long period of time, that equity should give you returns commensurate with that.
So over a long period of time, realistically, you should expect a 12-13% return from equity, unless of course you are a sophisticated investor, and then then that's a different story. But
Yes.
if you are a quote unquote index investor, 12, 13, 14% is a, if you do better than that, you should consider yourself lucky.
Yes.
Or smart, either of the two. But over a long period of time, that's the equity returns that you should expect, which is very unlike what we've seen in the
last 4
years. And by the way, which is where a little bit of the expectation has been built, that equity means 25% to if you don't, like, I'm sure your investors are telling you this, that we don't deliver 25%, you should not get a bonus or something, right? That's so that's another important one. The third one, Ashish, is that where are we today? Like, despite all the correction, are we now like average P, etc., that you spoke of? How does that look like?
So I think while we have seen a correction, I think if we look just on a simplistic P multiple basis, we are not really in the value zone.
Right.
Okay. So the P's are still elevated. Of course, it varies across the spectrum. Not all stocks, not all sectors are at the same place, but on average, market is still more expensive than it has historically been. And more than P, I think what is also really elevated is corporate profitability and margins. Right. So I think, and we spoke about this earlier, that corporate profit to GDP ratio has gone up from 2% to 5%. And actually, if you drill down into multiple sectors, so for example, if you look at some of the sector like automobiles, even consumer companies, durable companies. So many sectors, the industrial company, the margins of the companies are much higher than where they have historically averaged at. Right. Again, there are multiple explanations for this. One is that you had very strong demand growth coming out of COVID. Over 2013 to 18, there wasn't enough capacity creation, so supply was constrained. So you saw a lot more ability to take pricing. So pricing power was good, and now you are seeing in many sectors, right? So for example, in sectors like paints and cables, new players are entering, and that is bound to happen, because if the existing companies are making the ROEs they are making, that will obviously attract new players in the segment, right? So competition always drives down margin, right? Even if you see, for example, in the banking sector, margins are higher than where they have been historically been, right? So there are multiple sectors that are sitting on very high margins. So have some risk on the multiple, but you also have a risk on margins, right? And I think we'll discuss this probably more in the later section, but another reason in many sectors you saw margin expansion was that India increased protectionism from 2017-18, right? So you saw tariff barriers actually going up, a lot more quantitative controls also coming in many sectors, right? So I think if these are brought down, then external competition coming in will also suppress margins, right? So you have domestic competition being low in many sectors, that changing because new capacity is coming. So for example, you look at cement, you look at paint, you look at automobiles, everyone is now launching EVs. So new competition is coming in, and potential of external competition coming in as tariff and non-tariff barriers are lower. So there is this to margins as well. So I think that poses some challenges to the kind of earnings growth that will come in over the next couple of years, and it is in addition to the multiples a significant risk to the markets.
Right. So again, just in summary, despite the correction,
yes,
and actually a lot has been spoken about this correction, but despite the correction, both the multiples as well as the profitability
yes,
are higher than what they have been historically.
yes,
Which means that if the profitability is higher and the revenue growth has slowed, if the profitability slows, again there is a double impact on the profit growth, which is what finally matters. So that continues to be that is even now at further risk.
yes.
Unless obviously the economy rebounds and kind of things change and so on and so forth, which hopefully will happen, but it continues to be there is some risk there. And obviously the multiple also is elevated, so there is risk there. So goes back to your point of that it's not that there is a correction and now this is not like COVID that everything fell sharply and now everything will go back up sharply. We may see more choppiness coming up. Very helpful, Ashish. So we covered lots of things. Now moving on to what's happening in the global environment. So big tariff announcement yesterday. Great to hear your take on what that means.
Sure. So I think one thing or the most important thing about this announcement is that we should not treat this announcement as the thing to do our analysis, right?
Right.
I think both the magnitude of what he has announced as well as the way it has been announced that it's kind of covered really everyone means that it will have implication much beyond trade. Right. I think the actions that have come out of the US, it's going to redefine potentially geopolitics, right? Even say NATO, the Quad, etc. I think all this is going to get redefined. People will be rethinking many of these, right? Like in the Quad, as you know, it's Australia, India, Japan, US. So they were making the Quad as like a access potentially to for the China side, right? But now with what's happening, probably China and Australia will feel the need to be more economically engaged with each other, right? So we really don't know how this will get redefined, right? EU may also want to have much stronger relations with China, right? Because you cannot be reliant on the US, and particularly if US is kind of trying to pull back on NATO or NATO funding. So I think the implication that it will have will go far beyond just trade and trade policies. I think the other thing is that this is really the first act. Okay. We need to see what are the acts that follow, right? And that's why I said markets will be choppy, because things will change or potentially can change very dramatically over the coming days. Like whatever estimates we have, right? So U.S. imports about $3.3 trillion of goods, right? And U.S. is a 30 trillion economy, right? And what he has announced covers about 60% of this tariffs on 60% of this 3 trillion. If you do the weighted average of that, the total tariff bill goes up by about $650-700 billion, right? And that translates to about 2.8% of GDP, right? So it's really a big challenge, and in the short run, all this will not get produced in the US, right? So it will mean a higher burden on the US consumer, right? And the estimates are that US growth will fall from 2% to 0% for this year, right? And US inflation, where the expectation and the Fed expectation, I think, is 2.8. Now expectation are it will go up to 5%.
Wow.
Right. So the implications are a lot beyond trade. It's not just how much India will be able to export in auto or how much pharma will not be taxed, etc. So implications are a lot more in terms of what happens. And again, if this is the magnitude of the on US economy, will his popularity continue to be of the same level? Right? Will all Republican senators will still support him? I'm sure you would have seen the headline that the outgoing Senate actually reverse the tariffs he had put on Canada. Of course, that is irrelevant now, but I'm saying if there is a huge economic impact, what is the political continuity in the US, we don't know, right? And we should therefore prepare for the fact that even that can change, right? So will Trump continue for 4 years? I don't know. But I think what is the second order impact? So let's assume this is done, he continues. So what is the second order impact of this? That US growth and global growth will tank.
Right.
And so it's not just about higher tariff burden on these companies, but what happens to IT exports? Right. So for us, as much, so India exports 88 billion dollars to the US, imports $40 billion. That's how we have 47 billion dollars of surplus. But our surplus on the services side is much larger. Right. As you know, our services exports are now 11% of GDP. Right. So if US growth tanks, right, what is the impact on this 11% of GDP? And as you know, services exports have very high value addition, right? The Apple iPhone we export may be a big number, right? But the value add is very small. So the contribution to GDP is not that material. But what happens to this 11% of GDP where potentially our value add is 60-70%, right? So that is a bigger implication. And how does US economy, US Fed react to this, right? Because typically you would assume that, okay, if US growth is going to come down this materially, and there's already talk that there will be 2 quarters of technical recession this year, then you would expect the Fed would be more aggressive in cutting rates. But if inflation is going to go up, then they will not be able to do so. So then you get that dreaded word of stagflation. Right, that you have economy slowing and you have inflation. So I think those are the big challenges and which we need to ponder. I don't unfortunately have answers how it will pan out, but it is going to be very uncertain. Another aspect of it is that, okay, this is happening on the current account. What happens to the currencies now, right? Typically, currencies also adjust, right? Surprisingly, we did not see the US dollar or the DXY react overnight to this news. It was still at 103. but if DXY appreciates, right? And so if the dollar appreciates meaningfully, then actually you do not have the full impact of these tariffs, because the currency depreciation kind of erodes most of that benefit. In fact, one very interesting theoretical construct is that at the end of the day, current account deficit does not exist in isolation.
Right.
Okay. And one interesting way to look at it is that current account deficit is actually counterbalance of your capital.
Capital, yeah.
Right. So rather than focusing on your current account, if you say my current account deficit is equal to whatever my capital account surplus is.
Right.
Right. So the only way, therefore, you can say that you can bring down your current account deficit is you bring down your capital flow surplus. Right. And how does the US engineer that? Right. If if the talk is that because of tariffs, economies around the world will get more impacted, but US economy will get stronger because US will do major tax rate cuts, including corporate tax rate cuts, and people will be shifting more production into the US. What that will mean is that capital inflows into the US will be even stronger, right? So if capital inflows are stronger, then how can you have a narrower current account deficit, right? Because if you have strong capital account inflows, that will just mean your currency will appreciate.
Right.
So I think these are a lot of ponderables. We don't know how dust will settle, but what will happen is that the markets will keep reacting to these news flows. And I think one adage is that the biggest challenge for the equity market is uncertainty.
Yeah.
Right. And I believe we are in a period of heightened uncertainty. I'm sure you would have seen that graph. There's a global think tank that puts out a chart called Global Policy Uncertainty Index, right? And even before these announcements, that index was higher than ever before. It was like 1.5x higher than what it was during COVID, 2x higher what it was in GFC, right? Because that's the amount of uncertainty we have in policy making, because it's not just US who's trying to drive policy. How will EU respond? How will China respond? Will China now give a very large domestic stimulus, right? Because over the past few years, investors have been disappointed that China, to revive its economy, because it was being driven by investment in real estate, right? To revive its economy, it invested more in manufacturing and broad-based its export destinations away from the US, but really did not do enough to revive domestic consumption. So is it going to go that route now? So what policy actions other take is also very important. So I think because of the fact that this is only Act 1, we should not just base our investment decision on the announcement that have happened today. Second is many of these might get changed over time. Like even for India, there are bilateral talks that are happening. So where they will settle, we still don't know. So you have to be kind of bit reserved in passing judgments at this point of time, how it will settle. The only thing we can say with certainty that uncertainty will be higher,
Right.
but not conclusive really what the impact of this will be for a particular company or for the particular market.
Understood. So great. So Ashish, a few things I take away from this. First is that actually in all you spoke, you did not focus on the tariffs at all, right? And I guess that's the gist of your response, that at some level it is irrelevant what tariffs. I mean, it's not irrelevant, but it is not the decision point.
Yes,
because this is not an event.
Yeah.
It is a start of some bigger unraveling and
Yeah.
potentially a bigger change. and hence that change is going to impact far more than the event itself.
Yeah.
So that I would say is kind of point number one. Point number two, there are two, three, second, third order impact that you spoke of, which are very interesting to think about. First one is just what happens to the US itself. Like, does the economy may not go into a recession, but does it slow down materially? As an example, does inflation catch up materially? And kind of in the bigger scheme of things, however this plays out, if the US slows down, it can't be good for the global economy and it can't be good for India as well.
Yes.
If the US slows down, it will definitely have negative ramifications for us. So that is one kind of area. And actually how the Fed then reacts to that is another, like this taxation is by the way, the Fed's job in the last few years has not been easy.
Yes.
And now it will likely become even tougher. So there is that angle of what happens in the US. There is the angle of how other countries respond, like the China domestic stimulus. In Europe, we've already seen, right? Like Germany kind of make some fairly bold announcements, break from the past. Actually, it's a very clean break from their past stance, and so we likely see kind of a lot of that also happen. Irrespective of what happens to the tariffs, I think this idea is now seeded into people's minds, and so they will potentially go out and execute against it, which means we'll see some of these. And net, hence, while we don't know how this will play out, it is very clear that it has increased uncertainty, and uncertainty is not
good.
Not good. And this is the third, actually, in addition to the heightened multiple, the heightened profit margins, the question on the kind of growth as well. This is a additional quote unquote risk factor that exists on what happens to the future evolution of the markets. So very uncertain times. Nobody knows what the outcomes are, but the downside risks seem to outweigh the upside.
And I think if we go back to the start of our conversation, right? So that's why it's really important in this kind of environment to manage your risk, allocate your assets in a risk compliant way, right? So so you have multiple asset classes. You don't kind of either be very concentrated or over diversified, right? So kind of stick to those basics, because market will keep changing their sentiment maybe on a weekly basis or on a monthly basis.
No, I think on that point, it is just when you watch television and the kind of, you can actually, there's some reels on Twitter and Insta wherein they've taken one individual and shown that one individual's commentary over maybe a 3-month period, and it is just it's completely on one hand. It's like we have arrived, nothing is going to come in the way. To the other end, saying we are now 5-year recession and so on and so forth.
Yes.
And then we are now back to business, and the going is good again. So sentiments can change very, very fast. And not everybody can react that rapidly. Particularly retail investors, I think, cannot kind of react that rapidly, and they should not also.
Yes.
So that's another thing. Great. So Ashish, we covered a broad spectrum of things. We started with the F&O story, where things seem to be slowing down. Volumes are coming down. We are still kind of outliers. And so there is more to do, but the direction seems right. On the equity side, we discussed how in September when we spoke, everything was hunky-dory and, everything was rara. Your point then was that markets don't work that way. It's a market, which means there is a buyer and there is a seller. And when the demand for kind of from the buyer side goes up, markets finds ways to get more goods into the market. Like the seller side also finds ways to bring, in this case, paper. And so that has happened, plus other things have happened which have resulted in the choppy market. particularly both on the multiple as well as on the profit growth expectations. We were at a multi-year, multi-decade type of a peak, and both have then subsequently disappointed, and so that has caused some uncertainty. And your point to that is that equity markets are not a one-way street. It is a volatile market. Over a long period of time, people should expect a 12 to 14% type return, and hence, it is important to keep a long-term horizon and not kind of react to how the markets are moving. B, you also need to have your asset allocation. Not everything can be in equity. You need to plan for near-term expenses and near-term things. So you need to have money in fixed deposits, fixed income, gold, etc. as well. So diversification and portfolio allocation is critical. Over a long period of time, Indian equity markets almost always outperform all other asset classes. But this is definitely not true of shorter periods of times because there can be significant volatility. And so that was one important takeaway. We also discussed that despite the correction, even now, both the multiple as well as the profit margins are at historical highs. They're not at historical highs, but they are higher than historical averages. And so there is potentially further downside possible. And your expectation is that the markets will remain choppy. It is for sure, it's not again a one-way up street that has come back. And lastly, we discussed the global uncertainty, which is coming from the tariffs announcement, etc. Where what big takeaway is that the tariff itself it's a non-event. It's a start of something which is likely to unravel over time, and that unraveling will have many second, third, fourth order impacts, including what happens in the US. Potentially, we could see a sharp slowdown, a stagflationary type of situation as well, which can be actually quite devastating. And then there is the response of other countries, Europe, China, India as well. And, how they react could also how they react could change what happens very differently compared to, so the permutation combinations are too many and it's very difficult to predict everything. But the one undeniable reality is that the level of uncertainty has gone up materially. And so hence people should have their radars out and they should be thoughtful about how they think of their portfolios.
And again, I don't want to also say that given this, it only means that equity market can only head down from here, right? So for example, a scenario, if it plays out that US is able to engineer less capital inflows and money actually starts to flow out of the US, right? Because last 4-5 years, money has just been going into the US. So if money starts to flow out of the US, dollar weakens, then you see non-US assets and growth assets like India actually kind of do well. But again, it's very difficult to call out, and I don't think market will trend in one direction consistently for the year, right? So there will be periods of time that for a couple of months you will see inflows, couple of months you will see outflows. So you will see this coming through because policies are going to keep changing on the toss of a dime.
Absolutely. So again, basically, it is impossible to predict what will happen to the market. Your views that it is definitely not a one-way street. It is a choppy market. It could go up. We never know. In March, as you said, March was one of the best months in the last year or so. So it could go up. It could also go down. And hence, again, going back to the initial things you mentioned, long-term view, diversified portfolio, having a realistic expectation, perhaps the right way to approach the market. Thanks a lot, Ashish, for that conversation. It was a very interesting one.
Thank you.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.